Welcome to video number 6 from Emoji Trading, looking at how we trade using order flow. In our previous video, we started to think about the market in terms of supply and demand, and we considered how to spot when the market runs out of buyers or sellers, a situation that we refer to as exhaustion. When a market becomes exhausted, it becomes less likely that the direction it was trading in will continue. It may pause or it may even fall back. In this video, we're going to continue explaining how you can use the Emoji Trading Order Flow Suite to highlight areas of supply and demand in the market and use this visibility as a basis for your trading decisions. Price moves because of the actions of buyers and sellers. If we consider the state of the order book as we see in the DOM, the only reason that price will move is if a market order consumes the resting orders, the liquidity, at the price level in question. If we consider this DOM, if an order for 1,630 contracts lifts the offer at 53.25, the next offered price is going to be 53.5, where there are 347 contracts available. Likewise, if these get lifted in one go and nothing's replenished, the next offered price will be 53.75 and so on. In reality, most markets are pretty liquid, and price will trade backwards and forwards across many price levels. When a large order hits the market though, it can be sufficient to move the market to the extent that very little volume traded on the opposite side of the quote for this order. The traded volume at this particular price quote level will stand out as the thin spot. We'll see much less volume traded on one side within the numbers bar. These thin spots have the potential to form support and resistance because the large trades that created the thin spot will defend the price level when it's revisited. Of course, if this price level is not successfully defended, then the potential support or resistance that may be here is likely to reverse its role, and this is exactly how trend pullbacks occur and trends fail. The Emoji Thin Spot indicator highlights thin spots by indicating when the bid or the ask volume at a given price level was less than a user-defined percentage of the total bid or ask volume within the bar, and there was aggressive trading activity on the other side of the price quote. We can highlight the thin spot with a forward projection zone and also an extension line that will extend until price next meets the price level, so you've got a visual aid of the potential support or resistance level. Some traders will use thin spots as targets, looking for exhaustion in the prevailing trend and using the nearest thin spot as the first price target. Others will regard them as potential entry levels when there's a pullback to the prevailing trend. Some traders trade in both ways. Two other emoji indicators that are similar in concept to the thin spot indicator are the emoji single printer's gap and the zero print indicators. The trading rationale is similar to that behind thin spot. They highlight an excess of supply or demand. Single printer's gap will highlight single prints, in other words, traded volume under 10 at any level in the price bar. Zero print will highlight when no volume traded at a price bar, and depending upon the contract that you trade, this can be quite a rare situation and worthy of note. Let's also bear in mind the importance of delta as a measure of buying and selling power. The Emoji Trading delta divergence and delta sequence indicators, which we covered in video number 2, also provide great indications of potential reversals or slowdown. Delta divergence highlights situations where price has made a new high or low, but this is not supported by corresponding positive or negative delta. In other words, at a new high, we experienced more selling, in other words supply, than buying. Likewise, at a new low, we experienced more demand than supply. Delta sequence, similarly, will highlight when delta is falling. In other words, demand is decreasing and supply is increasing, or the other way round, when delta is rising. Demand is increasing and supply is falling. In our last video and this video, we've started to describe the market in terms of supply and demand, and we've used various emoji trading indicators to highlight these areas of supply and demand so that you can start to consider them as potential entry and exit points in your trading. One of the keys to successful trading is keeping things really simple, and I find that by not using the terms support and resistance, and certainly not using lagging and arbitrary price-based indicators, but rather always thinking in terms of, if we're at a given price level, are we experiencing supply or demand? Then in this way, we get a really clear and simple view of the market, and this helps us make quick trading decisions, which are not cluttered by confusing or maybe conflicting concepts. So I simply use various emoji indicators to highlight the areas of supply and demand in the market, and I look to trade in the direction of the supply and the demand. That's it. In our next video, we're going to introduce a final example of how you can interpret and make trading decisions using supply and demand levels. Before watching that though, it may be worth reviewing video number 2 on delta, our previous video where we introduced exhaustion, and going through this video on supply and demand once again, so that you're really reinforcing your visualization of the market into a series of supply and demand levels. See you in the next video.